Hi everyone. I want to start this lecture off. What we're looking at is the analysis portion of the analysis and journalizing notes and worksheet. So with the analysis portion, things that, some facts that we need to look at and need to understand, one is this double entry accounting system. So with double entry accounting systems, each transaction is going to have at least one debit. It's going to have at least one credit. Those debits have to equal our credit balances when we are looking at those particular items. The actual accounting process, and this is covered in 1 and 2, and we'll cover and continue the rest of it in 3 and 4. So what we look at is 1, we need to analyze our transactions. 2, we record those transactions, which is considered to journalize them. 3, we would post them. And 4, we would look at the trial balance. So what we're going to look at as far as this video is concerned is only that analyze feature. So with the analyze feature, what we are looking at is we need to figure out what 2 accounts, because everything has to have at least 2 accounts, maybe more. So at least what 2 accounts are going to be used in the transaction that we are looking at. The other thing we have to decide is this a monetary transaction? Do we need to journalize this particular transaction? Because if you'll remember back to some of our other notes, what we found is that we only record items that have a monetary value. So when we are looking at this analyze, so we're only doing A right now. When we're looking at this analyze feature, we're going to look at the transaction. So the first transaction is a business is started by receiving $150,000 from the owner. So the first question that I want you to ask on all of these different questions is this cash involved? So that the first question is about cash. In this case, yes, cash is involved in this particular journal entry. And so what is happening to cash? Well, cash is going to be increasing. So when cash, which is an asset, when we look at it increasing, it actually increases on the left side, which means it is a debit. So those are some of the things that we look at. Now I do have a cheat of sorts when cash is involved in a transaction because of the way that we create journal entries and the way that those journal entries are actually going to look. You have a date field, you have, that description, or I'm just going to call it an account right now, but account or description area, and then you have that debit and you have that credit field. So the way things are always written is, you would come in, you would put in your date for whatever that transaction might be, and then you would put in your account. So you would put in your debit account, and you'd put in your debit amount. Then you would indent over, you'd put in any credit accounts, and you'd put in your amount. Now what you see is that our debits are always going to be on the top of our journal entries. Our credits will always be on the bottom of our journal entries. So if cash is involved in a transaction and if cash is going up, that means that balance is going up. It's going to be on top, which automatically means that that's going to be a debit. So it's a little bit easier than having to go through the process of what's the classification and then what are we looking at. On the other side of this, what we see is, so what happened here? Why did we receive cash? Well, we received cash because the owner made an investment. When the owner makes an investment, this is going to be considered the capital account. So that's what we would use, be the capital account. If cash is the debit, then capital would have to be the credit. But it makes sense because we're increasing capital. And when we increase capital, that is going to be increased. If you remember back from our debit and credit video, that it will be increased on the right side. So that's that first entry. Now the second one, a business purchases land for $10,000. With a building for $60,000. Okay, so we have land and we have a building here. All right, so it tells us we purchase it. So our assumption, if we don't see something that says like on account or with a mortgage, is that we have actually purchased this with cash. So our first question is cash involved? The answer here is yes. What is happening to my cash? Well, my cash balance is going down because I'm purchasing something. And so that means that it will be on the bottom. It is going to be a credit. So what would my debit accounts be? Why is this happening to my cash? Well, I'm making a purchase. I'm purchasing land, which is going to be increasing, and I'm purchasing a building, which is going to be increasing. And when these assets increase, they increase on the debit side. So both of those are going to be debits. And this one actually has 3 accounts, not just one. Or not just those 2. So not just one debit and one credit. We're going to have 2 debits. And we'll learn about that next time as well. Next, a business purchased supplies for $200 on account. So the key word here is on account. On account means we didn't use the cash to make this purchase. Whenever you see on account, it's going to mean one of 2 things. It's going to mean either accounts payable or it's going to mean accounts receivable. When you make a purchase or you buy something, that is going to be accounts payable. So cash involved here, the answer is no, so we have to analyze the full transaction. So in this case, we have accounts payable. Accounts payable is a liability. This liability will be increasing. Liabilities increase on the right, which means that is a credit. Now, what did we purchase? Well, we purchased supplies. And so when we look at this, we see supplies. Supplies is an asset that is increasing. Assets increase on the left, which means that this is going to be our debit account. So the 2 accounts we would be looking at and that we would be using would be accounts payable and supplies in this particular entry. Our next one that we're going to analyze is a business purchases a year's worth of insurance. So it has the amount. We are making a purchase. Question here is cash. Yes, we've made a purchase. Doesn't say on account. Doesn't give us any terms. So we're purchasing that full year's worth. What's happening to our cash? Well, it's going down because we're making a purchase and we're paying for something. So that means that it's going to be on the bottom, which means that that is our credit account. So why is our cash going out? Well, our cash is going out because we purchased insurance. And we've not just purchased 1 month, we've purchased a whole year. So if you remember, this is going to be a prepaid item, not an expense, because an expense would just be for 1 month. This is a prepaid, and so the account that we would be using here is the asset account of prepaid insurance, and that in fact would be our debit account. For number 5, a business receives $1,000 for services that will be performed in the future. So here is cash. Well, yeah, it just told us we got $1,000 in, right? We received $1,000. So what's happening to cash? It's going up. That means it's going to be on top as the debit. Why? Why did we get this cash in? Well, we need to provide a service, but that's not going to be done until the future. So we haven't provided a service yet. We're going to provide the service in the future. So we owe somebody something. And so what we would see here, this is going to be a liability, and it's going to be our either unearned revenue account. The other account that could be used would be unearned fees. Those kind of mean the same thing. So we could use either of those two counts, and that is actually going to be what our credit's going to be for that, is one of those two accounts. 6, a business performs services to a customer for $500. Really probably should be for a customer, not to. $500. So what we see here is cash involved. Well, yes, the business performed services. They received $500, so that cash is going up. That means it's on top, which means it's the debit. Why did we get this cash? Well, because it said we performed services. Whenever you see the words perform services, that means you are looking at a revenue account. Now, revenue accounts that we can use for service can be quite a few. So we just have to look at our chart of accounts, see what's on our chart of accounts. It could be fees earned, because we have actually earned it because we provided that service. It also could be service revenue. And so you really just need to look at the chart of accounts, see what your revenue accounts are on the chart of accounts, and then move forward from that point on. And those actually would be the credit account is what we would be seeing. For number 7, a business pays rent for the month $1,000. So here again, cash. Answer is yes. What's happening to it? We're paying something, so that means it's going down. Since it's going down, it's going to be on the bottom. That will be our credit account. Why is my cash going down? Well, I have paid my rent, and it was only for 1 month, and so that would be an item that would be rent expense, and rent expense here would be the debit account. Okay. Number 8, a business buys equipment for $300. So here is cash involved. Well, yes it is. Why? Because we bought something. And it doesn't say on account. It doesn't give us any terms at all, which means we paid cash for it. And my cash is going down. That means it will be on the bottom. That is the credit. Why is my cash going down? Well, because I purchased what? Equipment. Now, equipment is an asset account. And when we look at that asset account, that asset is increasing, increases on the left. That means that's the debit. Although we didn't have to go through all that because we had our cheat, so we know that's the credit, that has to be the debit. The next one, a business performs services on account. So is cash involved here? No, it's not, which means we have to analyze the full transaction. So keywords that we see are on account, which means either accounts payable or it can mean accounts receivable. In this case, we have performed a service. Whenever we see performed service, we should realize that that is a revenue item. So which one of these two, accounts payable or accounts receivable, goes with revenue? Accounts receivable is going to go with revenue. We keep our R's together. So accounts receivable is going to go with revenue, so that's the one we're going to pick. Now, what revenue account? Well, we perform services, so our revenue account could be fees earned is a possibility. It also could be service revenue. It really just depends on what our chart of account is using for that particular one. In this case, we do have to analyze it because we do need to know what's going on. What's our debit? What is our credit? So accounts receivable is an asset. This asset is increasing. Assets increase on the left, which means that's my debit. This is a revenue item. Revenue is increasing. Revenues increase on the left as a credit. So that's how you would analyze it. Here, a customer pays on account $1,000. So here is cash involved. Yes, a customer paid their account. If a customer is paying their account, that means they are paying you, which means that your cash balance is going up. If your cash balance goes up, that means you're going to be on top. It is going to be a debit. Why? Well, a customer paid on their account. Now remember, I said if you ever saw on account or even the words on credit, that automatically means either accounts payable or it can mean accounts receivable. Okay? If we're dealing with customers, if we're dealing with receiving money, it's going to be the accounts receivable. So if cash is our debit, accounts receivable is going to be the credit. All right, a business hires a secretary. Is there any money or monetary deal here when we hire somebody? This is just hiring somebody. It doesn't say that she's worked. It doesn't say anything's happened. So in this particular case, there is no entry because there's no monetary. Because remember, that's that monetary assumption. Which means that to record something, it has to be in money, and this is not. We just hired somebody. That's all that happened here. Okay. Next one, a business pays the secretary's salary of $400. Well, this one is monetary. We're paying a salary, right? So what's happening here is cash. Yes, cash is. What's happening to it? Well, something's been paid, so it's going down, which means that's going to be on the bottom. That is the credit. Why is my cash going down? Well, I paid somebody's salary. Okay, so they've worked already. They've earned their salary. That is going to be a salary expense. If that's the credit, this has to be the debit. 13. A business pays for the supplies that were purchased earlier for $200. So keyword here, pays. That means that, yes, cash is going down. Going to be on the bottom. That is a credit. Why? Well, we paid for something purchased earlier. So did we purchase this now? No, we didn't purchase it now. We bought these supplies earlier in the month on credit. So now we're paying off that amount, which means we are paying what? We are paying an accounts payable balance. So accounts payable would be our other account, and that is our debit. Now at the end of the month, the owner takes a withdrawal of $1,000. So again, cash involved. Yes. What's happening to it? Well, the owner took money out of the business. That means the balance is going down. It's on the bottom. This will be a credit. Why is our cash going down? Well, the owner took money out. When the owner takes money out, the account that we are going to use is the drawing account, and that is going to be our debit account. So that is how we look at analyzing accounts. We have to figure out what accounts we're going to use, and then we have to figure out what account will be debited and what account would then be credited.